Slide 1. Title slide. US dollar hegemony: how one currency controls the global economy. Slide content. Global reserve currency dominance, structure, financial power, trade, sanctions and monetary influence, future of the international monetary system. The global economy operates through a hierarchy of currencies, institutions, and financial networks. At the center of this structure stands the United States dollar. The dollar is not merely a national currency, it is the primary unit of account for global trade, the dominant reserve asset held by central banks, and the main medium used in international financial settlements. This structural dominance provides the United States with economic flexibility and geopolitical leverage that no other country currently possesses. Understanding dollar hegemony requires analyzing history, institutional credibility, network effects, geopolitical strategy, and financial infrastructure. This presentation examines how the dollar achieved dominance, why it continues to maintain influence, and what risks could alter the future structure of global monetary power. Slide 2. What is dollar hegemony? Definition of dollar hegemony. Slide content. Dollar used as global reserve currency, dominant currency in international trade, primary unit for commodity pricing, core medium of global financial transactions, central bank hold dollar reserves. Dollar hegemony refers to the structural dominance of the US dollar in the global financial system. Countries use the dollar not only for trade with the United States but also for trade between themselves. Commodities such as oil, gold, wheat, and industrial metals are priced in dollars. International loans are frequently denominated in dollars. Central banks hold dollar denominated assets such as US Treasury bonds as reserves to stabilize their own currencies. The result is a self reinforcing system in which demand for dollars remains persistently high, allowing the United States to influence global liquidity conditions. Slide 3. Historical Foundation. Bretton Woods System. Slide content. Post World War II monetary system, dollar pegged to gold, other currencies pegged to dollar, US became global financial anchor, institutional trust established. The foundations of dollar dominance was established during the Bretton Woods Conference in 1944. After World War II, the United States held the majority of global gold reserves, possessed the strongest industrial economy. Countries agreed to peg their currencies to the US dollar while the dollar itself was pegged to gold at a fixed rate. This system positioned the United States as the central node of the international monetary system. Even after the gold standard ended in 1971, the institutional trust created during Bretton Woods ensured the dollar remained dominant. Slide 4. Petrodollar system, oil trade and dollar demand. Slide content. Oil price globally in dollars. Energy imports require dollar reserves. Persistent global demand for USD reinforces currency dominance. Script. The price of oil in dollars created a structural demand mechanism for the currency. Countries importing oil must hold dollars in reserve to purchase energy resources. This arrangement increases global reliance on the dollar and ensures continuous demand. Because energy is essential for industrial production, transportation, and military operations, the dollar's role in oil markets reinforces its geopolitical importance. The petrodollar system, because energy is essential for industrial production, transportation, and military operations, the dollar's role in oil markets reinforces its geopolitical importance. The petrodollar system strengthens network effects that maintain dollar supremacy. Slide 5. Network effects. Why the dollar remains dominant. Slide content. Widely accepted globally, lower transaction costs, liquidity advantage, deep financial markets, institutional credibility. Currencies benefit from network effects. The more participants use a currency, the more valuable and efficient it becomes. The US financial system offers highly liquid capital markets, meaning investors can easily buy or sell assets. US Treasury bonds are considered among the safest assets globally due to institutional stability. Because the dollar is widely accepted, switching to alternative currencies become costly and inefficient. This creates inertia that protects dollar dominance. Slide 6. Global reserve currency. Slide content. Countries hold US reserves used for crisis stabilization, supports exchange rate management, enables international trade payments. Script. Central bank maintain foreign exchange reserves to protect their own currencies from volatility. A large share of these reserves is held in US dollars. Holding dollar reserves allows countries to stabilize exchange rates, pay external debts, maintain confidence in their financial system. Because global trade is heavily denominated in dollars, countries require dollar liquidity to maintain economic stability during financial crises. Slide 7. Financial infrastructure power. Control of global payment systems. Slide content: Swift messaging systems, US Treasury market dominance, IMF and World Bank influence, global banking network integration. Script: Financial infrastructure reinforces dollar dominance, payment systems, banking regulations, and capital markets operate through networks that frequently rely on dollar settlement. International institutions such as the IMF and World Bank operate within a framework that historically aligns with dollar-based financial systems. Because many cross-border payments clear through US banks, the United States holds structural influence over financial flows. Slide 8. Sanctions power. Geopolitical influence through currency. Slides content. Sanctions restrict dollar access, limits international tradability, financial isolation as strategic tool, economic pressure without military force. Dollar dominance allows the United States to use financial sanctions as a strategic tool. Restricting access to dollar payment systems can limit a country's ability to trade internationally. This form of economic pressure can influence political decision making without direct military intervention. Sanctions leverage the structural centrality of the dollar in global finance. Advantages for the United States. Benefits of dollar hegemony. Lower borrowing costs, higher global demand for treasury bonds, ability to run trade deficits, strong financial influence globally, increased geopolitical leverage. Dollar dominance allows the United States to borrow at relatively low interest rates because global investors demand US Treasury bonds. The United States can sustain trade deficits without experiencing immediate currency collapse because demand for dollars remains strong. The ability to issue debt in one's own currency provides strategic flexibility that most countries do not possess. Cost of dollar dominance, structural trade-off, persistent trade deficits, manufacturing pressures, strong currency reduces export competitiveness, global responsibility burden. Dollar dominance also creates structural costs. A strong currency can reduce export competitiveness, contribute to trade deficits. Manufacturing industries may face pressure due to currency strength. Additionally, the United States must maintain financial stability because global markets depend on dollar liquidity. Economic instability in the United States can create global financial shocks. Challenges to dollar hegemony. Emerging competitors. Euro reserve diversification, Chinese yuan internationalization, gold accumulation by central banks, digital currency development, multipolar financial system possibility. Although the dollar remains dominant, alternative currencies are gradually increasing their share in global currencies. The euro provides regional diversification. China promotes international usage of the yuan in trade agreements. Some central banks increase gold reserve as a hedge against currency risk. Technological developments such as digital currencies may influence the structure of global payments in the future. Future of global monetary system, multipolar currency world. Gradual diversification possible. Dollar likely remains dominant. Structural inertia protects leadership. Transition would take decades. A sudden collapse of the dollar dominance is unlikely due to network effects and institutional depth. However, gradual diversification may occur over time. A multipolar currency system could emerge in which multiple currencies share influence. Such transitions historically take decades because financial systems evolve slowly. Conclusion: Structural power of currency. Currency dominance equal influence. Financial networks shape geopolitics. Dollar remains central to global systems. Future depends on institutional trust. Dollar hegemony represents structural economic power embedded within institutions, trade networks, and financial infrastructure. The dominance of the dollar is not accidental. It is supported by liquidity, credibility, military power, political stability, and network effects. While challenges exist, the dollar continues to function as the central axis of the global monetary system. Understanding this system is essential for analyzing geopolitics, trade, and international finance as well. Thank you very much.